Good evening, everyone. Time for part 6 in FOFOA's silver article. A lot of people have asked me why I'm spending so much time on this, and the reason why is I don't believe that FOFOA is the original FOA, and I'm not really sure who FOFOA is, but this is a really intelligent guy we're dealing with here. This is no ordinary shill. So most of the shills that I've dispatched are people who are in the mainstream media or carnival barker types on thestreet.com or MSN Money or some ridiculous media outlet, and they come up with just stupid arguments and nonsensical stuff. This guy, if you look at the stuff we've been citing here through the articles and the facts and the figures and stuff, this guy knows his stuff. Nobody can deny that he knows his stuff. This is complex spin is the best way to describe it. So that's the reason why I'm taking so much time to go through the entire article of FOFOA, because I have no doubt in my mind how intelligent this guy is, but I don't know what his motives are, and for that reason I want to dissect his arguments very carefully and make sure that the physical silver holders and investors are not chased out by complex spin and complex propaganda. So hopefully I can make it a little bit farther this time. So let's just jump right in here. We were on the SLV, and he says, okay, I know that some observers confidently claim the SLV is just a paper facade with no actual physical silver. No amount of audits or bar lists will ever convince some of you otherwise. So be it. Now, I've mentioned in other videos about the bar lists, and there are some very suspicious things in the bar lists. So this has been covered before, and he's kind of implying that it doesn't matter what evidence they produce, it's not going to convince you. Well, that's not necessarily the case. If the SLV had always produced a consistent bar list without the strange duplications and mysterious bars from places that no one's heard of and all kinds of weird stuff, you'll have to investigate it yourself. But again, here's the subtlety of FOFOA, the way he spins things, and we're going to see it here again in just a minute. But you need to research the bar list issue for yourself. So be it. For those readers with an open mind, so you see, if you're suspicious of the bar list, you don't have an open mind, I invite you to consider the possibility that they have physical silver as they claim. For the purpose of this story, it doesn't matter if that physical silver is encumbered with multiple claims. Look at this. He's already backtracking. Okay, so he's saying, yes, they have the silver, or they have some silver, but there might be multiple claims to that silver. You see how he's subtly backtracking on his argument here? It doesn't matter if that physical silver is encumbered with multiple claims, nor if the SLV holds some paper silver for periods of time. In a corner, the crucial issue would be who has the strongest claim to that SLV silver stock and the most influence and control over the flow of physical silver into and out of the SLV. The industrial silver users obviously had some concerns about SLV's potential clout. By the end of this narrative, they might wish it had been drowned at birth. So here's another real subtle argument you've got to pick up on here. He's arguing, and if you remember at the time, and he's going to cite it here next, but if you remember the time when the SLV came about, the SUA, the Silver Users Association, tried to stop it. And so now he's arguing that because they tried to do that, it must be legit. That's the spin. So back to the article. Prior to its launch, the industrial silver consumers lobbied hard to try and convince the SEC to deny approval for this new physical silver ETF. The Silver Users Association, whose members process 80% of all the silver used in the U.S., wrote a letter to the SEC in February of 2006. It warned the SUA opposes the creation of a silver ETF because of the concerns that doing so will require the holding of physical silver in allocated accounts, thus removing large amounts of silver from the market. Yeah, that's called investment. So, and the SUA, I don't know if any of you studied the SUA. You can go and read the articles at Charles Savoy's archive. Goes through the history of this organization and why it has conspired to suppress the price of silver so it can use it all up cheaply. It's a long and sordid history, but I invite you to go find Charles Savoy's archives. They're on David Morgan's silver-investor.com. Anyway, continuing. And indeed, the industrial silver consumers' fears have come to pass. In mid-December 2010, SLV's holdings hit an all-time high of 352 million ounces of silver bullion. To put this into perspective, global silver production in 2009 ran about 700 million ounces. American stock investors, by buying shares in SLV, have already absorbed the equivalent of half a year's worth of all the silver mined in the world. Now, he's making this sound like a big claim. All the silver mined in the world. Okay, 352 million ounces. Let's go back, grab our calculator. 352 million times the current price is $12 billion. Again, $12 billion is nothing in the scheme of things, and in the scheme of Wall Street. Apple, as I pointed out in other articles, Apple's a $200 to $300 billion company, so although he's making this sound like a lot, it's nothing. So you always have to keep those numbers in mind. As I said earlier, SLV is different to the other ETFs. Below, FOFA replies to a question I posed in February when we were discussing the idea of a silver open forum. Very interesting, considering that demand exerts no pressure on an ETF to grow in size. One has to wonder, physical contributions are the will of an owner or purchaser of physical silver to encase it in SLV in exchange for easily tradable shares. The price tracking function is simply a matter of market arbitrage, but of course this fact is not understood by the public. Very interesting. So this is a little confusing here, but essentially what he's saying is that it doesn't require the purchase of more silver for the price to rise. So right there, again, kind of calls into question how much silver does the SLV have to hold, and how is that related to the price of silver. So continuing, the custodians for SLV are HSBC and JP Morgan. Authorized participants create and redeem baskets of SLV shares. You can find a list of them here. Before we end this examination of ETFs, and SLV in particular, I would like to leave you with a question to ponder. Has the price of silver become more volatile since SLV and the other ETFs started to gain traction in the silver market? Martin Armstrong describes the typical behavior of commodities as they move through an uptrend in the extract about wheat from this essay. Quoting him, "In other words, we are about to make another thrust upward into a new trading band where the $6 to $7 level should become the floor. This is how commodities ratchet themselves higher, that some call inflation. What is actually taking place, there is a very broad trading range that becomes normal volatile swing between the peaks and the lows. The commodity will bounce off the floor and ceiling of this range until it starts to finally expand the trading ranges." I really don't know why he quotes Martin Armstrong for technical analysis. as far as support and resistance and trading ranges, because I don't support or discredit what Martin Armstrong says, but Martin Armstrong has a cyclical market sentiment understanding of the markets. He's not what you would call a technical person. He, as far as what I mean by technicals, which is support and resistance, he's using sentiment indicators that have to do with large swings in sentiment, and I just think it's interesting that he would quote Armstrong in this regard. Now let's examine the bullion banks as we look into a would-be corner operator's three most lethal weapons aside from unlimited free money: opacity, reach, and information. Opacity, reach, and market intelligence. Since the repeal of the Glass-Steagall Act, some international banks have become monoliths in banking, broking, dealing, and commodity trading, derivatives, research, private exchanges, and OTC markets. Even a vigilant, well-resourced regulator would struggle to prevent regulatory arbitrage by banks, traders, and speculators operating in multiple exchanges and markets in a number of legal jurisdictions. And vigilant, well-resourced regulators appear to be a little thin on the ground these days. The global activities of these banks are opaque to regulators. The bullion banks have the very best intel on the silver market. They have connections into every nook and cranny of this market, from miners to mints to margin traders. They also have the opportunity to make use of their own unallocated pooled silver accounts through fractional reserving. You can read about how bullion banks are able to leverage these pools here. And he actually links a GATA article. As we mentioned earlier, the COMEX is basically a paper silver market. Okay, well, that I agree with. The leverage in this market has been widely discussed since the revelations early in 2010 by the team at GATA and CMP, actually he means CPM. CPM Group's Jeffrey Christian. It is less widely known than another revealed 13 years earlier that the average in the LBMA was routinely 100 to 1. Let's clear up another popular misconception. This one concerns the LBMA. As Bron Suchecki explains here, the LBMA is not an exchange. It is an association. Transactions amongst LBMA members and their clients are private. Braun also reminds everyone that the LME does not trade physical silver. For anyone interested, here is a list of the market-making members of the LBMA. Some silver market analysts focus on COMEX reports and the BIS Bank Participation Report in order to draw conclusions about the positions of the bullion banks, and others in the silver market. Ed Steer of Casey Research writes, "The third graph is the number of U.S. and non-U.S. banks, and you can see the point that the CFTC began to withhold the number of banks so they could protect J.P. Morgan. They started withholding this data when Ted Butler discovered the Bank Participation Report back in 2008, and within months the CFTC pulled the data. And the last graph is just the two U.S. banks on their own and their respective long positions and their monstrous short positions. It's easy to see that JPM runs the silver price show." My emphasis. Let's assume that the information Ted Butler pounced on was as valuable as Ed Steer and Ted Butler seem to think. That line in Ed's report I highlighted in bold prompts me to ask, what does it tell you about the rest of the public data feed if useful data you unearth is pulled? Well, that's a good question. I don't think much of this data is really worth anything, and that's one of the small disagreements I have with Ted Butler. I think that Ted Butler relies too much on COMEX reports, the CFTC's announcements and things like that, but he's done a fantastic job. It's just going to be interesting to see how FOFOA tries to spin this, because you can see he uses Ted Butler, but then he's arguing against Ted Butler, so he's really shrewd, and we're just going to have to keep going to dissect this. So he's saying that you can't trust the data, but then again he's citing a lot of data. The allegation that JP Morgan, HSBC, etc. have massive naked short positions in the silver market rests on a range of published data from regulators and bankers, but primarily on the COMEX reports. As mentioned earlier, the silver COMEX is a market that accounts for only around 5% of the physical silver traded annually. One of the tactics recommended by some analysts to break the COMEX shorts is for all of the longs to stand for delivery. So readers may be interested in this explanation, and he links another article, Metal Augmenter, of trading between longs and shorts on the COMEX from Metal Augmenter's Silver Axe. Here are a couple of snippets. The longs cannot force delivery on the shorts, but the shorts can force delivery on the longs. Yes, most everybody has it bass backwards. The delivery timing is almost entirely dependent on the short. It is a short that announces an intention notice to deliver, and it is the long that is obligated to accept delivery, not the other way around. Okay, well, I haven't pre-read this, so I'm just going to comment on that. I honestly don't know what this guy is talking about. The mechanism in the futures market is that anybody who has a long contract who is intending to stand for delivery of the physical, if they do not sell by the exercise date, then that is just like an option. Then it becomes exercise. It automatically stands for delivery. So I really don't understand what he's saying when he says the longs can't force delivery on the shorts. That's really a nonsensical statement. Anybody who's long physical silver and does not cover that with either selling it or moving it out to another month, then if they cross that date, they're going to have to put up the full amount and they will stand for delivery, and at that point the short has no choice. So it looks like I'm going to have to do some investigation into this article by Metal Augmenter to understand why he's claiming that delivery is solely based on the choice of the shorts, because that doesn't make any sense. Of course, the shorts can stand for delivery if they choose to. Either party can do that, but we're going to have to investigate that and look into the article by Metal Augmenter, and I will address that in the next episode, and we'll talk to you next time.